Welcome to Tesla Daily News Podcast for Wednesday, January 14th, 2026. Today, we're tracking a fresh Model Y update in the US, a notable move in Tesla's solar business, new momentum for Tesla's charging network beyond Tesla drivers, and a big regulatory signal for autonomy in New York that investors should not ignore. Let's start with the most immediately commercial headline. Story 1. Tesla quietly refreshes the 2026 Model Y in the US and brings back the 7-seat option. Here's the hook. Tesla is using product iteration, not a full redesign, to widen the Model Y's addressable market again. Context. The Model Y remains Tesla's volume and profit anchor, but demand elasticity has been the key story for the last year. When EV competition intensifies, the fastest lever Tesla can pull is value, either through price, features, or new trims that hit more buyers without major factory retooling. Details. Electrek reports Tesla has officially launched the Model Y 7-seater in the United States, plus a set of smaller feature updates. The third row is described as tiny, which likely means it is best suited to kids or short trips, but it still matters because it changes how some families cross-shop against larger crossovers and three-row SUVs. Impact. For investors, the key is mix and demand capture. Adding a third row can nudge conversion rates for buyers who would otherwise leave the Tesla ecosystem, and the incremental cost to Tesla is typically much lower than launching a new model. If the take rate is meaningful, it can support unit volume without requiring another aggressive price cut. The risk is that feature-led demand is temporary and may not be enough to offset broader macro pressure. Takeaway. Watch Model Y order momentum in the US over the next few weeks. If Tesla pairs this update with financing incentives or regional inventory discounts, it would signal Tesla is still defending volume aggressively. Story 2. Tesla expands the Model Y lineup in Europe with a value-focused long-range variant. Hook. Tesla is trying to protect European share by widening its price-to-range sweet spot. Context. Europe is increasingly competitive, and local champions have been gaining ground in registrations. When incentives shift or competition offers similar range at lower prices, Tesla's advantage can narrow quickly. Details. Check outlet Zive reports Tesla has added a new variant called the Model Y Standard Long Range. The naming signals a standard equipment level paired with long range, essentially aiming for strong range while keeping the price closer to the entry models. Impact. This is strategically important for margins. A standard trim can reduce bill of materials and keep pricing attractive, while long range preserves a key Tesla selling point. If Tesla can keep manufacturing complexity contained at Gigafactory Berlin and maintain high utilization, this could be supportive for gross margin and limit the need for blunt price cuts. Takeaway. Investors should watch for two signals. First, whether this trim becomes widely available across major European markets, and second, whether we see margin commentary around Berlin production efficiency. Story 3. Incentives are back in at least one market, and that's a demand signal investors should not ignore. Hook. Tesla is using trade-in bonuses to stimulate purchases of Model 3 and Model Y. Context. When Tesla pushes incentives, it's often about smoothing demand and clearing inventory without headline price reductions. That can be less damaging to brand perception and residual values, but it still affects profitability. Details. An Australia-focused listing on OzBargain cites an email offer, a trade-in bonus of $3,000 for a new Model 3 or $2,000 for a new Model Y. The offer is described as limited time. Impact. For Tesla, the key question is whether incentives are localized demand tuning or a broader trend. If incentives widen across regions, investors typically interpret that as softer demand and potential margin headwinds. If it remains isolated, it may simply reflect competitive pressure in Australia or an inventory normalization push. Takeaway. Keep an eye on Tesla's incentive footprint. Incentives that creep into multiple markets can be an early warning for delivery expectations. Story 4. Tesla shows a rare sign of life in solar, with a US-made solar panel emphasized at Gigafactory New York. Hook. Tesla is signaling it still wants a seat at the solar table, and it is leaning into domestic manufacturing. Context. Tesla Energy has been the brighter spot versus Tesla's solar segment, which has looked muted for years. The market has questioned whether Tesla would keep investing in solar hardware or focus mostly on storage like Megapack and Powerwall. Details. Electrek reports Tesla updated its online configurator with a new solar panel that heavily emphasizes US manufacturing at Gigafactory New York. Impact. This matters for two reasons. First, narrative. It counters the idea that Tesla has abandoned solar. Second, policy and supply chain. Domestic manufacturing can play better with procurement preferences and potential incentives, and it can reduce exposure to import constraints. The financial impact will depend on whether Tesla can scale installations and maintain healthy attach rates with storage. Solar on its own has historically been lower margin and operationally complex. Takeaway: if Tesla starts reporting higher solar deployment numbers alongside storage growth, that would broaden the energy valuation story. But until we see volume, treat this as a strategic signal rather than a near-term earnings driver. Story 5. Tesla's Supercharger network keeps evolving into a platform business. Hook. Tesla's charging is becoming infrastructure for other operators, not just Tesla drivers. Context. Investors have increasingly viewed charging as a services layer, software, site hosting, and utilization-driven revenue. The key is turning a fixed-cost network into a higher-return asset through broader access and business partnerships. Details. Electrek reports that Francis Energy, a DC fast-charging infrastructure company, signed up for Tesla's Supercharger for Business program. Its first site in Oklahoma is set to officially launch tomorrow. Impact. This is important for utilization and scalability. If third-party operators adopt Tesla's hardware, payment stack, and operational model, Tesla can monetize charging technology beyond its own fleet growth. Higher charging utilization can also improve per-site economics and strengthen Tesla's strategic moat as more drivers adopt the North American charging standard. Takeaway: investors should watch for more Supercharger for Business announcements. The bigger this becomes, the more Tesla's charging network resembles a platform line item rather than a cost center. Story 6. New York may open the door to autonomous vehicle pilots, and that's a meaningful regulatory breadcrumb for Tesla. Hook. A state that has largely been on the sidelines is signaling it may allow limited self-driving pilots. Context. Autonomy is one of the largest valuation debates around Tesla. Regulation can move the timeline, both for Tesla and for competitors like Waymo and Zoox. New York is a major market, a major media amplifier, and a major precedent setter. Details. Wired reports New York Governor Kathy Hochul plans to propose a new law that would allow limited autonomous vehicle pilots in smaller cities, with the potential for broader services later. Impact. For Tesla investors, this is not a direct revenue event yet, but it affects the option value of FSD and any future robotaxi ambitions. If more states formalize pilot frameworks, it reduces regulatory uncertainty. That tends to support analyst narratives that autonomy is progressing from promise toward permitted operations, even if commercial scaling remains challenging. Takeaway. The market will want clarity on scope, what safety driver rules apply, what reporting requirements exist, and how quickly pilots could expand. This is a watchlist item for any autonomy re-rating. A quick market note before we wrap. One Taiwan Yahoo Finance report notes Tesla shares rose about 0.89% on Monday to roughly $448.96, with very heavy trading value. While also noting UK regulator Ofcom opened a formal investigation into Musk's Platform X under the Online Safety Act. This is not Tesla the company, but headline risk around Musk's other businesses can affect sentiment and volatility in Tesla, especially during high-volume trading periods. Now let's close. Today's big themes are: Tesla is defending and expanding demand with Model Y feature and trim strategy, using targeted incentives in some markets, quietly reviving a US-made solar hardware narrative, and pushing supercharging further toward a platform model. On autonomy, New York's proposed legislation is worth watching as a regulatory signal that could influence Tesla's long-term valuation story. For tomorrow, keep your eye on any further pricing or incentive changes, more details on Model Y configurations by region, and additional updates on charging partnerships that could point to accelerating non-Tesla utilization. If you found this helpful, subscribe to Tesla Daily News Podcast and follow for your daily, investor-focused Tesla Roundup.